The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very good morning to this edition of Squawk Box with Karen Cho and myself, Steve Sedgwick, and your headlines. So, markets react as strength in services and jobs data dampens expectations yet again for Fed rate cuts this year. Technology stocks leading declines with Nvidia hit by profit taking. Long-term UK borrowing costs rise. Now, this is the global trend, okay? But they do rise in the UK now to a 27-year high, risking a wipeout of the government's fiscal headroom and ratcheting up the pressure on the Chancellor of the Exchequer, Rachel Reeves.
Samsung says it expects to miss expectations in the fourth quarter, but shares move higher as Nvidia's CEO says he thinks the South Korean tech heavyweight can deliver chips suitable for AI systems. Social media giant Meta announces the end of its third-party fact-checking program and what CEO Mark Zuckerberg describes as a move back to our roots around free expression.
And wildfires ravage Southern California, forcing 30,000 people to evacuate their homes. The governor of California, Gavin Newsom, declaring a state of emergency. Good morning, good morning, good morning. How are you?
Very well, thank you. What a day.
Yes, but do you know what? Nothing happened. I really believe that. Nothing happened that you and I and other commentators have been looking at for a very, very long time. Let me explain briefly on this one as well. We'll go on the data. The jobs data was pretty strong, but it was mixed because you had the headline JOLTS figure, and you know I love a headline JOLTS figure more than any other headline figure in the whole of the great world. But it was robust. So tell me something we don't know about the US jobs market. And yet the quits was down, which indicates people want to hang on to their jobs for a bit more. So it was actually a nuanced but fairly bullish set of data. ISM, same kind of stuff. So what else happened? Well, bond yields carried on going up. Of course bond yields carried on going up because we've known for a very, very long time. Every single one of you knows that there is potentially an inflationary impact and a paper supply impact over the medium to longer term of Trump policies. Ergo, there's going to be more paper issued, more inflation. Ergo, you're going to take a little bit more money for actually buying that long-term US paper. And the third thing that happened that is a non-story is Nvidia went down. And I say it's a non-story because Nvidia went down on nothing, no news. Nvidia's doing brilliantly. They hit a record high and then they went down. But people thought, maybe it's a little bit high. Maybe I should take a little bit of profit on this one as well. So let's just go through it again. Data was strongish, same old. The fact that there are longer term risks, okay, we get it, same old. The fact that Nvidia is a well-priced stock, but a fantastic stock, but actually is prone to a bit of profit taking because it is so well thought of and so high and so many people have got it, same old. I don't know anything that was new that led to the sell-off yesterday.
The writing was on the wall, and I was asking questions yesterday as to whether everybody was on the same side of the trade. I mean, we've spoken to so many people to start out this year about how they're positioning, and no one could say a bad word about US equities. So a lot of overweight positions in that direction, even with known risks. And we were talking yesterday with Gam about those known risks being whether inflation could come into the mix, yields go up again from here, some of those tariff policies that could be negative for the US backdrop, but still in a context where you've got a US growing. So to me, it was a market that was primed for some bumpiness on the stock market action because you've got so many bullish positions out there. And I think we got a dose of bad news. Again, that reality check, if you look at the devil in the detail, for me, it was in the ISM yesterday. It was on the prices index in particular, 64.4%, an increase of 6.2 points or more than 10%. So effectively, it was telling you that already prices are grinding higher. If we have a tariff policy that suggests that there's going to be further pressure, then you might see more heat on the inflation side. So I think it it was a real precursor to what could be lying ahead on the prices side. So that was a real wake-up call for the interest rate expectations for this year. And don't forget, as we started out January, we were talking about 2 to 3 rate cuts from the US Federal Reserve. Now we're talking about the very slim prospect of one. So a reassessment, and particularly if you think about technology names, I mean, we saw a fairly significant retreat in the NASDAQ 100, worst trading day since the 18th of December, a fall of about 1.8%. We saw it on other major parts of the NASDAQ too. That is where we saw a fall as well. So I think on all those tech plays, there was a real wake-up call that, look, if we see yields continuing to move high from here, what does that mean for the pricing action already so far in January for these big stocks?
Let me. You are spot on with everything you just said, no doubt about it. But let me diverge on the last thing you said, wake-up call on the technology side a little bit. We get spun lots of lines on this channel because let's be brutally honest about it. On this channel, most people who come on to say something are trying to sell something. Mm-hmm. And I don't have a problem with that, but let's be cognizant of the people who say buy Nvidia have probably got Nvidia. The people who say buy Bitcoin have probably got Bitcoin. So when we hear technology stocks, well, don't worry about the cycle. Don't worry about interest rates because it's a structural change story. What they're presenting us is a structural change. And yet the next day, people are telling us, oh, interest rates are going to be higher for longer. That's a real concern for the technology stocks because it changes the forward discounted model, what have you, of cash flow and what have you. So they can't have it both ways. Either interest rates matter or they don't matter because this is a structural change story. And I love the fact that on a different day, the same person will tell us the different story.
There's a timing perspective here, and I heard some commentary on the back of CES saying, look, given this is such a big technology event, you're really going to have peak AI sentiment this week. And I think if you look at what the market is now assessing, saying, look, are we going to get the returns from AI as soon as we had hoped we would? And if that means you're looking at quarterly and yearly performance for tech stocks and for Nvidia this year, what are you going to get in the Nvidia trade? And I think the market was just a little bit concerned that perhaps, we escalated again yesterday. It seemed as though we're going in one-way direction for Nvidia as we started out this year. And we were at the highest level is what we saw for the stock since the IPO back in January 1999. So we did go up. Fresh intraday all-time high, then we went down. So I think the market was just trying to judge what is in the price for now on Nvidia. And there's no doubt there's been a ton of hype, again, from Jensen Huang around the AI story this week.
Yeah, I mean, it's like, dare I say, even on our own channel, I'm not criticising, because I'm sure that's what our journalists have been told. But there's a headline on CNBC, Bitcoin drops below 97,000 as Treasury yields pressure risk assets. But I thought this was a structural story of why. So surely, if there are concerns about inflation and fiat currencies and overissuance of US bonds and large amounts of dollars sloshing around, then you can construct an argument another day why Bitcoin should be rallying. So I'm not saying that this is inaccurate what our journalists have been told, but Bitcoin should be immune to that, shouldn't it?
There's a correlation. Every time tech sells off, Bitcoin sells off too. So that was an absolute playbook that we've seen many, many times before.
But why, Karen? If Bitcoin is supposed to be something completely different, it's supposed to be a new currency that can be relied on, a new asset class that can be relied on, regardless of the vast amount of issuance in Treasury world, in sovereign world, in corporate bond world.
That was always one of the
This
original
is a limited.
arguments.
There's only 11 million coins going to be ever be out there, despite the fact that there's 13,000 other Bitcoin or cryptos out there.
But you don't escalate to 100K very quickly on the price action of an asset, so-called asset class, on purely fundamentals, do you? I mean, a lot of this is hype. There's this momentum trading around Bitcoin. To me, what was interesting was around foreign exchange markets as well, because don't forget, we'd seen a little bit of softness starting to creep back into the dollar in the 24-hour period around the tariff story. If there's a tariff-light regime, then what does that mean for the dollar trade? The dollar had come off a little bit against some of the pairs and crosses. Yesterday, as the market looked at some of that data, we saw the escalation to a 2-year high on the dollar index. So it was a real reversal, I think, for me on the Forex market, which was really interesting to watch.
But I think, and I know you're going to move to the US markets now, but it actually makes our job even more interesting in 2025 because we're not rocket scientists to say that even though the data is always important, it's going to be even more important. If you can see that kind of reaction on ISM and jolts when they weren't that unbelievably extraordinary, they were okay, but they weren't extraordinary. Imagine what we're going to get on payroll. Imagine what we're going to get on PCE. Imagine what we're going to get on retail sales. Karen, we're getting a very exciting 2025.
Yeah, to that point, we've got an exciting week, don't we? We've got the US market shut, and then we've got the payrolls to contend with, and the market now thinking the next stop, if we get some sort of blowout number on payrolls, that could be market moving. So for those that are looking to dip a toe in the water around what could be a buying opportunity thanks to the markets coming off a little bit overnight, might be cautious because we've got to wait it out now for that jobs report Friday. If we take a look at that market action, you can see in particular the Nasdaq that had gone up a day earlier, falling by almost the same extent, down 1.9%, and give back on the S&P 500. The Dow still falling, down 0.4%. 6 negative session in 7 is not what we've witnessed for the Dow. I want to take you to Nvidia, and I mentioned the intraday highs, what we witnessed burst up as the stock kept on climbing thanks to the CES hype story, but then falling more than 6%, so the worst trading day since the 3rd of September. So just taking some of that steam off the trade that we've witnessed so far for 2025. Now, on the US tech names, there's been a lot of buy signals for the analysts around some of the Mag 7 stocks, but it was not the case yesterday where the price action matched up with some of those recommendations. You can see Tesla reversing 4%, 2% down for Meta, and it was a big day for Meta. We'll talk about that more around some of the changes around censorship. But Apple down more than 1%, and Microsoft also giving back similar territory. To treasuries, this is where the heat has been coming into the mix, and it may seem boring to some of the traders out there, but the bond markets often have a signaling function, and we've been seeing it in recent sessions around the long end of the curve, the very long end, the 30-year, 4.91. So we're grinding towards that 5% handle. The 10-year has also shown some increases in recent trading sessions. This morning we're a little bit lower at 4.68%, and the short end 4.28% as the market again grapples with whether it's 1 or 3 interest rate reductions for this year.
Super duper. Right, let's go into a bit more granular detail on the conversation that Karen and I have already spent 10 minutes on. US service sector activity expanded in December, but concerns over tariffs continue to weigh on expectations. The ISM Services Index rose a better than expected 2 percentage points to 54.1, representing the share of businesses expecting growth. The measure of prices surged more than 6 points to 64.4% as Fed policymakers take a more cautious approach to cutting rates. Meanwhile, US job openings hit a 6-month high, as discussed in November. According to the latest JOLT survey, available positions rose to 8.1 million. That is well ahead of estimates. Well, our US colleagues will be speaking to the US Treasury Secretary Janet Yellen today. You can tune into that interview from 16:10 GMT. And they'll also speak to one of my favourite chief economists, that's the ADP one in this case, Neela Richardson. That interview 13:15 GMT, Karen.
Quick look at the Asian markets in session, and we have a real mixed bag across the region. We're down on Tokyo stocks slightly, 0.2 plus. The Hong Kong market also in reverse, and we've got the Shanghai Composite showing just a slight dip into negative territory, in contrast to the Kospi that has bounced to 1.3%. So South Korean stocks very much on the front foot, and Samsung helping to power some of those moves despite a real challenging picture, I think, in some of the conversations it was having to analysts yesterday. Now, Samsung Electronics says it expects to miss forecasts on the top and bottom line in the fourth quarter. The chip maker guided for operating profit of 6.5 trillion won in the period, but shares are moving higher today after NVIDIA CEO Jensen Huang told a press briefing that he expects the company will be able to redesign its high bandwidth memory chips to meet NVIDIA's standards for new AI systems. Let's get out to Sherry for more. Sherry, one of the competitors seems to have the jump on Samsung at the moment, SK Hynix, and they've been having a very strong partnership with NVIDIA. But the comments from Jensen Huang suggest that there's still an avenue here for Samsung to catch up.
That's right. And if you look at the spread in their price action today, really Jensen Huang's commentary moving some needles in South Korean stock markets, because it's, if anything, if a Samsung does pass NVIDIA's qualification test, it means more intense competition for SK Hynix as well, which is down 0.2% for the day. And Jensen Huang did point out how Samsung would need to engineer a new design, but of course the market is really hanging on to those words. And of course it's been happening a few times that he has been really teasing, and the stock actually reacted to that. I think it's also the valuation story, not just Jensen Huang's words, because we've got Samsung and SK Hynix is sitting at low valuation compared to their memory maker competitor over in the United States, Micron Technology. So I think that is another layer to it. And South Korea overall is looking relatively cheap. So when you want to get into South Korea and then you're looking for some kind of chip exposure, and there we go, Samsung Electronics is getting some love from foreign and domestic institutions for the day. I think the street is still divided at the moment. From some of the guests that we spoke to earlier this morning on CNBC, Dan Ives of Wedbush Securities saying that the concern around Samsung is overdone, but we've got a retail researcher saying that Samsung still requires extensive restructuring as well as strategic adjustments to regain leadership and investor trust. So we'll see how things go. If 2025 is a year that Samsung actually makes some tangible progress when it comes to high bandwidth memory chips. Guys, it's back to you.
Super duper. Thank you very much indeed for that, as ever, Sherry. Right, AI startup Anthropic is in late-stage talks to raise as much as $2 billion at a $60 billion valuation, CNBC has confirmed. A person familiar with the matter said the funding round would be led by Lightspeed Venture Partners. Anthropic has been backed by Amazon and Google and is the creator of Amazon's Claude AI bot.
Coming up on the show, the yield on the 30-year gilt hits its highest level since 1998 as investors grow increasingly concerned over UK's stagflation and fiscal policy. Plus, Meta chief Mark Zuckerberg takes a leaf out of Elon Musk and X's playbook when it comes to what he describes as accuracy and censorship. We'll discuss. And luxury car maker Rolls-Royce answers to rising demand with a major investment into its Goodwood HQ. We'll hear from the CEO Chris Brownridge this morning at 8:30 GMT. That is a first on CNBC. UK long-term borrowing costs hit their highest level since 1998 on Tuesday. The yield on the 30-year gilt climbed towards 5.3%, while the 20-year also jumped. Now, the increase in borrowing costs highlights investor concerns over stagflationary pressures in the UK, the Labour government's fiscal plans, and a general uptick in global inflation with the dawn of Donald Trump's second term in the White House. Let's get to Bryn Jones, head of fixed income at Rathbones. Bryn, you've been very active in terms of calling out the high yield here. And just to remind the audience that you've been worried about this post-budget, that you've emailed the Chancellor and the Prime Minister about the issue and also written an open letter about these issues. Just talk to us as to why you think there are genuine issues around the UK yield versus what we're seeing globally, where longer-term yields seem to be escalating in lockstep.
Yeah, I mean, in the UK, what's really been a big concern is that, in particular, Capital Economics put a piece out yesterday where they're very concerned that the rise in yield that we've seen has a big implication because it kind of wiped out the headroom that the government has said that they had, to bring the accounts into budget by 2029. And the recent rise in yield has meant that there's very little of that left. In fact, if we get another rise in yield in the next few days, that will completely wipe out. Also, on top of that, if the OBR decide to reduce the economic projections of GDP, let's say by about 0.1 to 0.2%, that's also going to have a big implication from fiscal policy. So whilst the government have promised to be able to borrow, they won't be able to because they're effectively just borrowing to pay interest, and that's something I've been very worried about. And as a result, there's a little bit of confidence that's been lost in the long end of the bond market. If we're expecting central banks to be cutting rates, over the next 12 months, we shouldn't be seeing yields rising so aggressively. So there seems to be, it feels like the fiscal policy seems to be out of kilter with the direction of what we should be going in. And in particular in the UK market, that's been most evident, with perhaps more aggressive rise in yield. And as you already stated, to levels we haven't seen since in over a quarter of a decade, quarter of a century. That's slightly concerning.
Bryn, let's marry up what we're seeing in business circles with what's happening on the bond market, because there has been a negative reaction, I think it's fair to say, across the UK about tax policy and the extra costs that the businesses are bearing from here. Are the screws too tight to grow the economy, and is that causing some further pressure for the UK?
Well, it's always a fine balancing act. The increase in national insurance is going to have a big implication for some companies, in particular those smaller companies where they're paying their staff kind of minimum wage anyway, and those rises in minimum wage have a big implication. We've seen it in the retail sector, in particular in the sort of not-for-profit sector as well, and that's a slight concern, because that kind of moves things away from what they're trying to achieve. Yes, and let's take the politics out of this. Let's talk about interest rates. When they rise, historically, that's led to slowdowns because it costs people to do business. It costs people more to borrow. It costs consumers more. And it becomes much more of a tightrope, because if earnings start to collapse because growth's weak, then margins get squeezed pretty quickly. And those businesses that have got low margins or high gearing will start to suffer. And, we haven't seen one of these cycles because of QE and central bank policy support for over 2 decades. And so taking politics out of it, if you actually think about it, higher interest rates tend to lead to slower economies anyway.
Brilliant.
So if you've got... Yeah, sorry, Steve.
Yeah, I'll just come in here, Bryn. I get what you're saying. We've got to take the politics out. I couldn't agree more. Because, as we know, some of the politicians are woeful at their job, including, let's be honest about it, the Truss Kwarteng budget. It may not have been a bad idea to have a growth strategy, but the fact is their communication strategy was appalling, and ergo the crisis we had. I don't think this lot are the same. And again, we're taking the politics out of it. So my question for you is, I get it. Gilts, yields, sovereigns across the board, the yields are getting higher. There are real concerns about supply. There are real concerns about inflation. This is not just a UK phenomenon as well. Is this a good opportunity to buy that long end, or to buy anywhere on the curve?
Yeah, possibly. I mean, going to your point, there was a famous quote saying that, I don't want to come back as a particular baseball player, but, I want to come back as the bond market because I can intimidate anyone. And that's very much what we're seeing from the gilt market. But you're right, to some sense, we look at some statistics. If you look at the duration of the gilt market, we go back to 2020, and the duration of the gilt market was 13 years. It's currently just under 8. That shows that the kind of the risk adjusted yields that you can achieve from the belly of the curve, for example, are pretty attractive. So we all talk about Sharpe ratios, the return you can get for each ounce of risk, and the Sharpe ratios for gilt markets are looking quite attractive. And let's not forget the tax efficiency of gilts. There were a lot of bonds issued with very low coupons, and currently in the UK, for example, you don't get any CGT on your positions. If you've got a low coupon, you've got very low income tax, even as a high rate taxpayer. So you can generate sort of 4.5% return after tax. Now, there aren't many risk assets where after tax, after your CGT, you can generate that kind of return. So from a tax efficiency perspective, they're quite attractive. And if we're at this mature stage of a cycle and we do get an aggressive slowdown, that having a gilt or a bond portfolio that's paying you 5% as an insurance policy is quite attractive.
So you may not look it, but I know that it's your 21st birthday this year. It's your 21st year at Rathbones. I knew it was one or the other. You do look old enough, yes. But the point being here, my friend, is you've seen it all in the last 2 decades as well. Is the rise in global sovereign yields you're seeing going to lead to something concerning in the corporate bond market, which historically has acted as the canary in the coal mine for the equity market?
Spreads are tight, right? So there's not much left in the credit markets over and above, a bit more of juice maybe from some takeouts of legacy and financials. Look, private credit markets are huge now. They weren't around when I first started like they are. And what we can't see is this sort of opaque market. It's not that transparent. We talk about residential mortgage-backed securities in the US again. There's a lot of defaults there, but we're not really seeing it in the banks. Maybe it's being worn somewhere else. One of the biggest dangerous things is to say this time is different. What I would say is that actually the rise in yields will effectively impact refinance costs. So we know there's a big refinance will come in Europe in the high yield market. At what point? It's when, as I say, when earnings start to collapse and rates are too high, those margins get squeezed, and those highly geared companies struggle very, very quickly. And that's the space. That's the canary, is seeing when the earnings in those highly geared companies start to fall and their costs go up, and we start getting defaults. And that kind of has a knock-on effect to employment and various other things. So I don't think we're going to see a major disruption. But that's what I would be looking out for.
Lovely to see you from the hotbed of fixed income that is Oxted. Thank you very much indeed for joining us, as ever. Lovely, lovely town, by the way. Bryn Jones, thank you, sir. Head of fixed income at Rathbones. You been to Oxted?
I don't think I have.
Sorry.
No.
Very nice.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.